Hello friends, welcome to the channel JAIIB and CAIIB Made Simple. In this lecture, we are going to quickly revise our PPB unit number 25 in just 10 minutes. So I request you to give your valuable 10 minutes toward this particular video, understand each and every concept that will equip you with enough concept so as to solve any type of MCQ that will be asked from this particular unit. The topic name is Types of Collateral and their characteristics. So let's begin. So first thing first, that what is credit risk, right? So credit risk is the chance that someone who borrow money from a bank might not pay it back. To reduce the risks, bank asks for asset like property as collateral to secure the loan, right? Now what makes good security? First thing, it should have a clear title. Good security need to have few key features which I am describing. It should have a clear title, meaning there are no legal issue. Second thing, it should be easy to identify and sell if needed. It should not have any liabilities or debt attached. Also, the owner should have absolute control over it. It must have a stable market value and be easy to store. Now, let's talk about secured versus unsecured loan. There are two main types of loan. One is called secure, other is called unsecured. Secured loan means borrower gives the asset like property or bond as collateral, right? The bank hold these in case the borrower can't repay. And the second is called unsecured loan, means no asset are given and the bank trusts the borrower ability and integrity to repay. Now the question is, why secured loan? See, banks prefer secured loan because they have a backup if things goes wrong. If borrower struggle, and the bank can use the collateral to recover the money. Now let's talk about the types of security. See, banks accept different types of asset as security, like immovable asset, which includes land and building, like movable asset, which includes things like car and gold, like financial asset, which includes investment or receivable, right? And the last is intangible asset, which includes brand value and goodwill. So in short, credit risk is a big deal for bank and security helps them manage it. Whether it is secured or unsecured, the bank goal is to reduce risk and protect their money. Now let's talk about bank can't sell the land and building if someone can't repay their loan. Thanks to bank can sell, not can't sell, bank can sell the land and building if someone can't repay their loan thanks to the SARFAESI Act. The good news, land usually goes up in value, but it is not all easy. Valuing property can be tricky and getting a clear title takes time and money, right? That is the disadvantage. The good news is that land value increases over the time, and the bad news you already know. Now agriculture land. Agriculture land is not as valuable as other type of property because of laws like land ceiling and debt relief. So these laws are in place. Because of this, agriculture land is not as valuable. It is also harder to sell quickly and may bring in less money. Plus you know the legal cost, right? The legal cost like a stamp duty, registration, you can see it written, a stamp duty, registration adds to the expense. Now what are the documents required from mortgager? So when using land as security, bank need a lot of document like title document, sale deed or gift deed. The next is parent document, that means the 30-year history of ownership. Next, encumbrance certificate, a 13-year check to ensure there are no debt. Tax receipt, proof that the property is in possession. Court permission needed if the land is owned by a minor. Search report, if it is company owned property then search report is required. Lawyer's report to make sure the title is clear. Now let's talk about the valuation of the property. Before giving out a loan, bank need to know the value of the property. This is done by an approved engineer. The property value depends on things like construction type, location, tax, right? Construction type, building age, title, tax, whether it is freehold or leasehold, etc. Now let's talk about the security value perception. Finally, the value bank gives to the property as security depends on its own policy and how much risk they are willing to take. So land and building can make good security for loan, but there are a lot of steps involved in valuing and securing them, right? Now let's talk about this ownership, which is freehold versus leasehold. When you own a property, it can either be a freehold or it can be leasehold. Freehold means you own the property and the lands it is on completely, right? Freehold means you are owning the property and land also on which it is on. And leasehold means what? Leasehold means you own the property but someone else own the land. You can use it for a set of number of years, but after that let the landowner take it back unless you renew the lease, right? So that is called leasehold property. Now what is the goods advantage of goods as a security? Now let's talk about the goods. See, bank often use goods like stock or merchandise as security for the loan, right? Goods like stock and merchandise are used by bank as security, right? These things are used as security for the loan. Here is why. What is the advantage of goods as security? Goods are usually easy to sell because there is a ready market, and goods valuation is simple. They are tangible, you can see and touch them. Loans are usually short term, right? Which reduce the risk, and also it is cheap and easy to create a charge on good, especially when dealing with trustworthy customer. Now what are the disadvantages? Goods can spoil or deteriorate. There is a risk of fraud or dishonesty. The value of goods can fluctuate, and it's sometimes hard to know its real value, and selling large amount quickly can be difficult, and there are also storage and transportation issues, right? So now what are the precautions bank take? Bank takes several precautions when giving loan against goods. The first is, if the goods are pledged, bank hold the goods. So the first case is, suppose the goods are pledged, so bank, obviously in the case of pledge, bank holds possession. And if it is hypothecated, the borrower keeps possession. You know the difference between pledge and hypothecation, right? Okay. Now the second thing is that bank prefer goods that are non-perishable, in demand, and easy to price and manage. Loan are not given for risky activity like speculation or hoarding. Banks are also check the goods are fully paid for, stored securely, and now let's talk about the inspection and related aspect. See, very important concept. Bank need to regularly inspect the goods that borrower use as security for loan. Here is how they manage it. The first is called stock arrangement. Goods should be arranged so that they are easy to check, and any hazardous good need to be stored separately. Next thing is godown. So these are also called warehouses. So these should be secure and easily accessible for bank official. Regular inspection. Banks sometimes do surprise inspection to ensure everything is in order. It is important not to rely on the borrower vehicle for this visit. Next thing is stock audit. Verification means bank will count, weigh and check the stock and compare it with the borrower record, including purchase and sales data. The next is stock audit. For larger loan, bank perform a yearly stock audit to ensure everything is accounted for. Next thing is valuation. Goods are valued based on either cost or market price, whichever is lower, right? Non-moving stock, item that are not selling, is not included. Next thing is professional valuer. Experts like CA, engineer, stock valuer are sometimes hired to assess the goods. Now let's talk about the trust receipt. So trust receipt and the precaution bank take. First thing is title document versus acknowledgement. Sometimes documents like title deed can be pledged as security, but other like warehouse receipt cannot be transferred as security. Remember it, very important. There is always the risk of fraud, false document or unpaid vendor issue that can make the bank security worthless. To reduce this risk, bank always verify the document authenticity of the document. Make sure the goods are insured. Get a copy of consignment paper in the bank's name. Now the question is, what is this trust receipt? A trust receipt is a document where the borrower holds the goods or proceed from the sales of goods in trust for the bank. Even if the borrower become insolvent, the bank can still claim the goods. The borrower sign a letter acknowledging that the bank has right over the goods and sale proceed, making sure that everything is properly insured and that the unsold goods are returned to the bank. So that is called trust receipt. It is a document where borrower holds the goods or proceed from the sales of the goods in trust for the bank, right? Okay, so this is the important points related to the trust receipt. So to summarize, inspection and trust receipt help bank ensure that goods or used as security are safe and well managed. Now let's talk about advance against life insurance. So life insurance policy are considered good security for loan because they are regulated. First thing is they are regulated, which makes it easy for bank to claim them if needed. Bank can easily assign the policy to themselves. The longer the policy has been in place, the higher the surrender value. If the borrower passes away, the policy can be used to liquidate the loan. If the borrower default, the bank can quickly get their money by surrendering the policy. Now, disadvantage to watch out for. See, but there are also few things to keep in mind. If the borrower does not pay the premium, the policy can lapse, right? And reviving it is not easy. Next thing is, if the borrower misrepresent or does not disclose important information, the policy can become void. The policy holder must have an insurable interest, meaning they have to benefit from the insured person life. Otherwise, the policy won't be valid. Some policy have restrictive clause, which means they can limit how much the insurer will pay, right? So that is what you have to see also. Now there are some key consideration. Bank need to be careful when accepting life insurance policy as security. The policy must be assigned in the bank favor and be free from any other claim. The next thing is that policy must be original, currently in force, and all premium should be up to date. Some life insurance policy come with condition that may make them unsuitable for security. And once a policy is assigned to the bank, the nominee, means the person who would receive the benefit, is automatically cancelled. Right. So once a policy is assigned to the bank, the nominee is automatically cancelled. So in short, life insurance policy can be a great security for loan, but there are some key things to keep in mind, which we have just discussed. Now let's talk about advance against sayer. So every aspect we are touching. See, advance against sayer, bank offer loan using sayer as security, but there are some rules. The first rule is that only listed equity share are acceptable. Unlisted share are rarely allowed. Right, you know, some shares are listed on the stock exchange, only those are applicable. And share must be full paid and it is dematerialized form. The loan must be for productive purpose, right? It must be for productive purpose, not speculative. Now, what are the advantages of advance against share? The first is that using share as security has several benefits. First thing is that it is easy to figure out the value of the share. Value as ascertainment is quite easy. Share tend to be stable and provide intermittent income. And there is a minimum paperwork, and releasing the security is straightforward. But there are some disadvantages also. Share price can fluctuate, and there is a risk of fraud. Partly paid share are harder to sell and may have a restricted market. Right, for partly paid share they are restricted market. Now what are the precautions that banks should take? See, bank need to be careful while lending against share. They maintain an updated share list, regularly review the portfolio, and set limit on how much can be borrowed. They also take margin which is for partly paid share to reduce the risk. And one thing you must remember, bank can't hold more than 30% of their own or any company paid up share when it comes to share. Remember this, very important. RBI guidelines say all loan and investment in share must follow RBI guideline, which set a strict provision to protect bank. Now, what about the bank capital market exposure? Let's talk about how bank manage their exposure to the capital market. Bank directly invest in equity share, convertible bond, debenture, mutual fund. Giving loan against share, bond or mutual fund. Bank can also have, this is how direct exposure. And indirect exposure means giving advance against share, bond, debenture, equity, mutual fund. Offering loan for investment in share, bond, mutual fund. Or giving loan secured by share, bond, where primary security does not fully cover the advance. Means the primary security is not enough to cover the loan fully. So in summary, bank offer loan against share, but they follow a strict rule. Right, now let's talk about the stock broker exposure. And so bank often give loan to a stock broker, either secured or unsecured, to help them with their trading activity. They may also provide guarantee for a stock broker or market maker. Additionally, bank can give loan to companies for the promoter's equity contribution. You can see written promoter security contribution when starting new business. So these also count as a part of bank's capital market exposure. Bank must follow a strict rule when it comes to capital market exposure. This includes financing a stock broker for margin trading and exposure to VC, a venture capital fund. Bank total capital market exposure, which includes both fund and non-fund, must not exceed 40% of the bank net worth. And the direct exposure to share, bond or mutual fund must not goes over 20% of the net worth. Remember these two are very important. Total capital market exposure not should exceed 40%, and direct exposure should not exceed 20%. Banks also need to manage their consolidated exposure. Right, banks should manage their consolidated exposure, meaning the total of their capital market related loans. These two must not exceed 40% of the net worth, with direct exposure capped at 20%. For advance, bank has to ensure loan are for legitimate purpose only and are valued at market price. No loan are given for acquiring a controlling interest in the company. Bank can't give loan against partly paid share or to partnership firm where the shares are used as a primary security. Now, so these are the important things to keep in mind. Already I have told you consolidated exposure, already we have discussed in the previous slide. Now, advance against share, bond, debenture to individual, very important. When it's come to individual, bank follow this guideline. The board of director sets the rule for sanctioning such loan. Indian bank cannot provide backing for overseas loan if the Indian client is investing in Indian share or bond. There is 50% margin requirement for loan against share and IPO financing. For capital market guarantees, the bank need to maintain a 25% cash margin as a part of 50%. Now let's talk about the temporary overdraft, OD. So banks sometimes offer temporary overdraft to help with short-term financing need. The same margin rule applies if the stockbroker are using overdraft for finance. What is the purpose of overdraft? It is used to cover contingencies, personal need, or to buy new share either through right issue or through secondary market. Loan limit, so up to 10 lakh if you are dealing with physical security, and up to 20 lakh for dematerialized share. Now let's move on to the loan against share for individual. So these loans are meant for genuine investor, not for stock broking or group loan, back-to-back specific loan. Loan policy, bank follow RBI guideline. Margin requirement, remember for physical share debenture 50% margin is required. For dematerialized share debenture 25% margin is required. Bank may set high margin if needed, especially for preference share or non-convertible debenture. Individual can borrow up to 10 lakh, maximum 10 lakh when subscribing to IPO. Now bank can also issue guarantee to a stock or commodity broker for their exchange margin requirement, right? But there are some safeguards to protect both bank and borrower. Bank assess the borrower actual need, set exposure limit, and establish sub-ceiling for loan and stockbroker. Loan are not provided for arbitrage operation. Remember it. When I say arbitrage means when a broker try to profit from price difference between market. For that, no loan is provided. Next topic we have to discuss is bank finance for market maker and margin trading. Margin trading is when a stockbroker borrow fund to trade, and it is restricted by the 40%. Just move to here. So you can see that it is restricted by the 40% capital market exposure limit. Bank required a 50% margin on the fund lent for margin trading, and the share must be in dematerialized form and placed to the lending bank. Second thing is monitoring and safeguard. See, bank must constantly monitor that the 50% margin is maintained. Additionally, bank board need to ensure that there is no improper relationship or nexus between the bank and stockbroker when handling margin trading. Now let's talk about advance against unit of mutual fund and debenture. So for mutual fund, the unit must be listed or have a repurchase ability. They should have completed their lock-in period, and the loan is linked to the NAV, that is net asset value or market value. For debenture, they are not considered as a primary security for corporate loan, but can be accepted as collateral for secured loan. The promoter share used as a collateral must be in dematerialized form. Bank can accept debenture as collateral for temporary margin arrangement if the borrower is short of fund. Now what is the bank policy and corporate loans? So bank need a detailed loan policy for a stockbroker and market maker covering loan purpose, collateral, exposure limit. Remember, for collateral loan there is a limit. Any advance provided for promoter contribution is treated as bank investment in share, which also fall under 40% exposure limit, right? So obviously bank plays a crucial role in market finance. So this was all about our unit number 25. Hopefully you enjoy the session. If you want PDF of the session, you can enroll in our PPB capsule course program. Detail regarding the program is available in the description section. I have provided the link. If you really feel that this such type of content is useful to you, please hit the like button and also write yes in the comment section. This will make me understand that you really want the next video. Thank you.